Hi there, welcome to Kneppy Invest. Mark Twain once said that history doesn't repeat, but it often does rhyme. And I think you can use that saying in all facets of life. And I use that particular saying when it comes to investing, because what has worked in the past can work right now and in the future. And the whole reason I'm doing this particular series, looking at the best performed ASX small companies since 2013. The period is between May 31st, 2013 and May 31st, 2023. And why I did a previous series looking at the best performed ASX bigger companies since 2013 is to look for those characteristics of companies that have performed in that 10-year period. And if we can find some characteristics, we can then use that for our investing decisions right now and in the future. So I've already gone through the first series looking at those companies with a market cap above $1 billion. This particular series is featuring companies that had a market cap below $1 billion as of May 31st, 2013. I've already gone through the honorable mentions and those companies that came in between 30th and 21st. Now we're in the top 20, looking at those companies that came in between 20th and 16th. Now, interestingly enough, of these 5 companies, 4 of them I'm owning right now in my portfolio, and I plan to own these 4 companies for as long as possible. And the other company I recently sold. It was a trading position, and I decided to take some profits because at that point in time, that position was up 20%. So remember, what I am looking for in doing this exercise, this project, is characteristics of fairly similar characteristics of these best performing companies on the ASX since 2013. Now, before we have a look at the companies, just got to go through some rules I actually did use to come up with this list. In this particular series, the number one rule I had was in terms of market cap. So all these companies had a market cap below $1 billion as of May 31st, 2023. My previous series featured companies with a market cap above $1 billion as of that date. So have a look out for that series. The second rule I did use is I wanted to exclude story stocks because a lot of times story stocks run on sentiment. That's the only thing that is driving the share price higher or lower of these story stocks, companies without revenue. It's all about sentiment. It's all about the story. It's all about marketing. So I wanted to exclude those companies because, to be honest with you, those companies have no any type of characteristics that I'm looking for in terms of a long-term investor. Also decided not to include any mining companies. The whole reason behind not including mining companies is because they're highly cyclical. In fact, you can say they're completely cyclical. The total returns you're going to see in mining companies is completely dependent on the underlying commodity the company is mining for. And sometimes you'll see some companies, like lithium companies, have gone a massive run during a short period of time. Sometimes it's iron ore companies, sometimes it's gold companies. But the main thing is mining companies are price takers and they are completely cyclical. So I didn't want to include any companies that are completely cyclical, that are price takers. And the final rule, and this is quite important, I'm looking at total returns. So not only share price appreciation, also including dividends. Now, to be honest with you, the majority of the best performed companies over the past 10 years do not have high dividend payouts. And this is understandable because those companies that or have a high dividend payout are more likely not growth companies. In fact, it's going to be much harder for these type of companies to grow because it's all about the capital allocation decision, and the management of these companies decide, well, we're bringing all this money into the company and we're going to give all that money back to the shareholders in terms of dividend. So we have no money left over to grow the company. So one of the main characteristics of these best performing companies on the ASX is they have fairly low dividend yield, if any dividend at all. Now, this is quite an important point, and you actually might argue with me, and I'll probably listen to your argument, that this particular point is contradictory to that history doesn't repeat, but it often does rhyme. Past performance is not a predictor for future success. And this is absolutely true. Just because some of these companies have performed really well in the past 10 years doesn't necessarily mean they will perform well in the next 10 years. But still, I'm looking for those characteristics that led these companies to perform really well in the past 10 years and whether we can use those characteristics to choose companies today and in the future. Coming in at number 20 is Collins Food. Collins Food owns KFC, not only Australia, but also overseas, Netherlands, Germany, places like that. Also Taco Bell. Now, I don't think Taco Bell is yet profitable. It's on the cusp of being profitable, and I hope they stick with it because I very rarely go to fast food restaurants, but I did go to Taco Bell yesterday just to test them out. One of the meals they did have, someone I know wanted to test it, and I thought, I'll have that meal as well. It was cheap. It was $10. I think it was the burrito crispy chicken or something like that, and I was pleasantly surprised by what I had. In fact, one of the reasons I don't go to fast food restaurants all that often is because the quality of food tends to be quite low. You get what you pay for, but in these times where the cost of living has increased significantly over the past few years, I probably would say that more people are going to fast food restaurants, particularly over sit-down restaurants, because it is just cheaper. But pleasantly surprised by Taco Bell. But just because I liked it doesn't mean other people would like it. So at this point in time, Taco Bell is struggling. But the last time I did have a look at how it is performing, it has picked up its performance and is on the cusp of being profitable. Now, let's have a look at the last 10 years financial performance of Collins Food. So we're looking at revenue per share growth, earnings per share growth, dividend growth, and then we're going to look at the gross margins, return on equity, and then the analyzed total return. So revenue, earnings per share, and dividend growth all nicely sitting between 9 and 11.4%. I probably would prefer revenue per share growth to be a little bit higher than 9.3%, but you can't really complain about these growth numbers over the past 10 years. Gross margins nicely at 49.7, return equity at 13.1. I do want to see return equity, return invested capital, return assets, return on capital to be above 10. If it's below 10, that is a massive red flag, particularly if it's consistently below 10. That means the company is really going to struggle to grow in the future. So return on equity, return on invested capital, return on capital, no matter what you prefer, that needs to be above 10 in my opinion. So analyzed total return for Collins Food, 21.46%. Now you might say and wonder why the analyzed total return is greater than the earnings per share growth. Now, the other thing I should mention here, earnings per share growth is higher than revenue per share growth. And one of the reasons behind that is because of increased margins. And then analyzed total return, almost double earnings per share growth, which means over the past 10 years, there has been multiple expansion for Collins Food. The market is willing to pay more of a premium for this company than it was back in 2013, which makes sense because the market cap of this company just before or around about May 31st was 950 million. Now it's 1.4 billion. The reason it's 1.4 billion is because the share price has taken off. They've released a couple of positive financial data and all news, and share price has increased 50%. So right now, Collins Food belongs in my other series, looking at those companies with a market cap above $1 billion. But the market cap has increased from 175 million to 1.4 billion in just over 10 years. So when the market cap of this company was sitting at 175 million, there would have been a little bit more skepticism around this company. Fund managers would be less willing to buy this company. Now they're more willing because it's a bigger company, and that's why the company has gone through multiple expansion over the past 10 years. So as a shareholder, or if you were a shareholder of this company since 2013, there's no reason to complain. You'd be very happy with a total return per year of 21.46%. The other thing to take into account here is shares on issue haven't increased all that much, only gone from 94 million to 117 million. So not a lot of dilution for shareholders over the past 10 years. So good performance from Collins Food, and that's why it's coming at number 20 in this particular list. I probably should also mention I did trade Collins Food, took a nice little 20% profit recently, And this is the weekly chart here, going back to 2013, at a beautiful looking chart. The only bit of weakness was during the COVID-19 financial panic, and most companies on the ASX, you do see this little blip when you do look at the chart, but also from about the start of 2022 through to about the start of 2023. So 2022 was a bad year for Collins Foods. Share price of this company fell from $13.50 to $7, so almost half in that 1 year. And when the share price got down to $7, this company did look really attractive in terms of valuation. Now the share price has recovered back up to about $13. So it's almost doubled since the start of 2023. And the share price right now is in a really nice uptrend. And maybe I should have taken profits because the share price has risen above from when I sold. But a beautiful looking chart. Share price has increased from about $1.50 back in the middle of 2013 to a current share price of about $13. So almost a 10 bagger over the past 10 years. So the next 5 companies in this particular list are companies I own and hopefully I'll own for the long term. Coming in number 19 is Nick Scali Furniture. And in my opinion, this is a high quality retail company and really impressive growth over the past 10 years. In my opinion, again, this is a more impressive company than Collins Foods. You might say it's a little bit more discretionary because they deal with furniture, and I think the market expected the financial performance of this company to be highly affected, negatively affected, because of rising interest rates and people spending less money on furniture. But it doesn't look like the hit has been as severe as what the market anticipated. Now let's have a look at some of the financial growth in this company over the past 10 years. Revenue per share growth, nice, 14.3% per year. Earnings per share growth, nice, at 21.7% per year. Dividend growth, 24.1%. So again, earnings per share growth growing at a much better rate than revenue, and that means margins have been growing. Gross margins at 63.5, quite good for a company like this. And I think that has to do with the business model. So they don't have furniture in the store, and I believe if you want to buy furniture from Nick Scali, it takes time. Either they make it overseas and they bring it here or something like that. Anyway, I've never bought furniture from Nick Scali. I have no reason to buy furniture from Nick Scali, but just because not willing to buy furniture from Nick Scali doesn't mean it's not an investable company. Return on equity really high at 62.1. I had to check this. So all these numbers come from Guru Focus. So when I saw the return on equity of Nick Scali at 62.1, I had to check the most recent financial data. And yes, return equity for this company is really high, which means this company has a much better chance of significant growth in the future because a really high return on equity. And analyzed total return nicely at 21.52% per year. You'll notice the analyzed total return right now is fairly similar than the earnings per share growth. In fact, slightly below, which means that this company has gone through no multiple expansion over the past 10 years. In fact, hasn't even gone through multiple contraction. So 10 years ago, the market was willing to pay a certain price, and now it's sort of willing to pay the same sort of price or the multiple, say, PE ratio, that sort of thing. Now, the market cap of Nick Scali has increased from 170 million to 790 million. I have a feeling the market cap of this company might be around $1 billion as we speak because the share price has improved or increased since May 31st. And the other thing to like or even love about this company is the shares on issue. This company's shares on issue or shares outstanding has remained the same over the past 10 years at 81 million. And that means this company has done no capital raisings over the past 10 years, no dilution to shareholders. And that is one thing to like about Nick Scali, among many things to like about this company. Sometimes I wonder why I'm showing you the charts of these companies because you're going to see fairly similar charts. Again, subtle difference between these charts, but you're going to see the share price moving from the bottom left to the top right. Sometimes the share price does not actually end at the top right, just like Nick Scali here, just like Collins Foods, because the share price high for Nick Scali was actually back at the start of, or the end of 2021, start of 2022. The share price reached a high of $16. And just like Collins Foods and many other companies, there was a blip at the start of 2020 in March of that year, February, March, during the COVID-19 financial panic. The other thing you'll notice is the share price went sideways in 2017, 2018, and 2019. And during the post-COVID-19 financial panic, that's when we saw the share price really take off. In fact, the share price of Nick Scali went from $3 at the bottom of the COVID-19 panic to a high of $16. So, in fact, a five bagger over about a month or about a year and a half period. Share price has, I won't say it's struggled since then, but the market has been skeptical because this company was a beneficiary of working from home, that sort of thing, lockdowns, because people were buying furniture like it was going out of style, out of business. And the market has been thinking, because everyone bought furniture during that period, no one is willing to buy furniture anymore. And it doesn't quite work like that. People are still buying furniture. Nick Scali is still performing really well financially. And the share price has just broken out. Just looking at this chart right now, again, a weekly chart. And even though I do own this company, I don't look at charts of companies I own for the long term all that often. Some people might be surprised by that. And I'm just looking at the chart here. The last week, the share price looks like it has broken out above $12.50. And $12.50 was a little bit of a resistance zone for this company. And the last time the share price was this high for Nick Scali was way back, the start of 2022. So we're almost talking about a 2-year high for Nick Scali's share price. Coming in at number 18 is Fiducian Financial Services. This company is still fairly small. So even though you will see some small companies on this list, in fact, I believe the company that came in number one this list still has a market below $100 million, if you can believe that. Anyway, Fiducian Financial Services. I've owned this company for a while, and the main reason I own this company is just because consistent growth through time. And you can see that with the revenue per share, earnings per share, and dividend growth, 12.5, 15.5, and 19.5%. Net margins, 23.9%. Return equity, nice, 25.3. Nothing to complain about there. And the annualized total return at 23.03%. So there has been a little bit of multiple expansion over the past 10 years because that total return is a little bit higher than earnings per share growth. And that doesn't take into account dividend either. So I think you have to include dividend when you look or comparing analyzed total return to the earnings per share growth. Market cap has increased from 36 million, which does seem really low for this type of company back in 2013. And companies like this had really low P/E ratios back then, particularly between 2008 and 2013. 2009, many people were telling me I was crazy to go into the stock market. That was the time to start investing. When everyone is telling you it's dangerous, it's risky to be in the stock market, is a time to start really going hard into the stock market. So market cap is increased from 36 million to 186 million. And just like Nick Scali, one of the things to like about this company is the shares on issue. Not many shares on issue, only 32 million, but this company has not raised capital over the past 10 years. If they have raised capital, it's been for a very small amount because shares on issue have gone absolutely nowhere in the past 10 years. Now onto the weekly chart for Fiducian, and back in 2013, I actually forgot to tell you that Nick Scali's share price went from about $1.50 to a current share price of 13. So about a 10 bagger over the past 10 years. Fiducian share price has gone from about $1.80 to a current share price around about $6.50. The high for this company was back at $9 in 2000 or late 2021. You can actually see there has been a downtrend in this company's share price over the past 2 years. And I have been waiting for the downtrend to come to an end. And there is a possible sign, a signal that the downtrend is trying to come to an end. And if I do see the downtrend or have confirmation the downtrend is coming to an end, I might take a position in this company or add to my position in this company when I do get that confirmation, because I do think this company is, I won't say cheap right now, probably won't say fairly valued, but probably in between cheap and fairly valued right now. Coming in at number 17 is a familiar company because I did a standalone financial year 23 result video for Laser Bond, another company I owned. I haven't owned this as long as some of the other companies I own in my portfolio. This was just a company I wanted to own. And then I saw opportunity when the share price dipped for about a month. But an impressive company, another small cap company. When I say small cap, I'm talking about a company with a market cap below $100 million. In my definition, that is the real definition of small cap. Laser Bond currently has a market cap of only $88 million. But 10 years ago, this company had a market cap of $11 million. So again, back in 2013, particularly between 2009 and around about 2013-14, you could have bought many companies on the ASX at really good value. That was a time to become excited about investing in the stock market. Now let's have a look at the financial performance of LaserBond over the past 10 years. Revenue per share growth, nice at 11.6%. Earnings per share growth at 25%. So that difference between revenue per share and earnings per share growth is because of increasing margins. Dividend growth, so this company is a dividend paying company at 17% per year. And even though I was sort of poo-pooing dividend companies, one thing I like to see in terms of growth companies is when they have a token dividend, typically a small dividend yield maybe 1 to 2%, and they can grow that dividend over time. That is wonderful, because if you don't sell that company based off your initial capital, maybe in 10 years' time, the dividend yield on your initial capital could be 10, 20, 50% if the company keeps on growing. That's another reason to fall in love with growth companies that have a small dividend. Gross margin at 53%, return on equity a nice 15.4. So you'll see a common characteristics already. Revenue per share growth, earnings per share growth, dividend growth, all above 10 for all these companies. Return on equity above 10 for all these companies. In fact, most of the companies above 15, and that all equates to high quality companies or potential high quality companies that give a really good analyzed total return for their shareholders. 24.5% per year over the past 10 years. You can't complain of that if you're a shareholder in that period. Again, markup $11 million to $88 million. Whoops, I've got to go now because there is a delivery. Now, where was I? So the market cap has increased eightfold from 11 million to 88 million. Now, unlike a few of the other companies on this particular list, shares on issue have increased over the past 10 years, and not all that much, from 85 million to 111 million. But again, just like other companies on these lists, you're not going to complain about those type of annualized total returns. 24.5% per year, you are going to take that. However, when it comes to LaserBond, you had to be real patient with this company. If you're a shareholder back in 2013, you got to see that when we look at the chart. So yes, this is a weekly chart for LaserBond, and the share price did absolutely nothing from 2013 all the way through to towards the end of 2018, start of 2019. That's when we saw the breakout in the share price. Volume started to increase, which is a good sign. And the share price went on an absolute tear just before COVID-19. I still remember that period. In fact, I was a shareholder of this company for a period during that uptrend cycle. In fact, the share price of LaserBond went from about 12 cents to a high of almost $1 in about a 1 year period. And then, of course, the share price fell all the way back down to 24 cents during the COVID-19 financial panic, and then the V-shaped recovery. In fact, the share price went back up to about $1 in the middle of 2021. Share price has been going sideways since then. And even though the financial performance of the company has been improving, share price is going sideways, which means over the past 2 or 3 years, this company has gone through multiple contraction. Not multiple expansion, multiple contraction. So I think right now, LaserBond is way more attractive than it was back in 2021, because financially the company is better off, and valuation, the company is looking quite attractive at current prices. Coming in at number 16 is another company I've owned. I've owned this company for quite a few years now. I've actually done a video on this company for a while. Share price has been struggling recently. I still have confidence in the company, in the management. Really impressive growth over the past few years. And let's have a look at the financial performance of Kneppy. Now, we don't have earnings per share growth or dividend growth because 10 years ago, this company had no earnings and no dividend. In fact, the earnings would have been negative because it was a loss-making company. But we can look at the revenue growth, 46.2% per year. That is a really impressive revenue growth. Maybe it's on a small base back 10 years ago, but really impressive growth over the past, say, 5 years. Gross margins at 88.4. One thing to like about this company, really high margins. Return on equity, 21.4. Probably would like that to be a little bit higher, but I can't really complain about return on equity that is above 20. That is definitely what I'm looking for in a company that I want to invest in for the long term. And the analyzed total return, 25.11. Now, the market cap of this company has gone from 64 million to 980 million. So that's greater than a 10 bagger in terms of market cap, but maybe not for shareholders, because the shares on issue have increased from 35 million to 49 million, which may not seem a lot, but a 14 million share increase on a 35 million base. So that's not quite a 50% increase in shares. So I could do a quick calculation. That would be about a 30 to 35% increase in shares on issue over the past 10 years. And that's why, even though the market cap increase has looked really impressive, not quite a 10 bagger for shareholders. And I'll confirm that when we look at the chart. So let's have a look at the chart right now. But again, who would ever complain about a 25.11% analyzed return for a company you own in your portfolio? If you are complaining, you might have issues. Now, when we look at the weekly chart for Kneppy, few things to really notice here. So back in 2013, share price of this company was around about $2, maybe $2 or $3, something like that. And the share price high for this company was actually back in 2019, if you believe that, September of that year. Share price actually reached a high of $46. Yes, $46. The share price got close to that level towards the end of 2021, reached about $44. And right now, the share price is down to $16. So share price has more than halved since its high. I'm not sure why. The company keeps on succeeding, keeps on producing financially, but the sentiment in this company, for some reason, is actually quite negative. I have heard some people complain about management, their remuneration's too great, that sort of thing. I've also heard some people talk about competitors in the area, but any competitors still going to be a few years, maybe 5 years before any of these competitors make any noise in this area. So fairly low sentiment in this company. A nice sort of support area around about $13. Share price struggled to get below $13 twice in the past 4 years. Share price got close to $13 about 2 or 3 months ago, got to $14. But share price has really struggled over the past few years, and I am going to maintain my holding in this company because even though the company keeps on growing financially, share price actually dropped, which means the P/E ratio or the valuation metrics of the company look way more impressive than they did back in 2019 and 2021. And back then, the main complaint about this company was it was overvalued. The valuation of this company was too high. I don't think you could say that right now because the valuation of Plentyville, based off their financial growth, looks actually quite attractive at current levels. And that is all I have for this look at companies that came in at 20th or between 20th and 16th of the best performed ASX small companies since 2013. You'll notice some common characteristics between these 5 companies and the other companies on this list, the other 25 companies. And I won't point out those characteristics or those common characteristics because I'm pretty sure it's quite obvious. Anyway, if you have any questions, any thoughts about these particular 5 companies, I'd love to hear them. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.